Australia's economy has barely grown throughout the year, and living standards continue to go backwards. Australians are getting poorer. The 2023 to 24 financial year has been the worst for the Australian economy, aside from the pandemic, since the 1992 recession. As for the prices in Australia, well, the price of Australian-made Vegemite in Sydney is 37% higher than in London. Coupled with the current negative news, wars, falling iron ore prices, and the Black Monday in August, whether you own a home or not, you might start worrying. Is the crash of Australian house prices inevitable during this recession? In this video, we'll dive into the facts and data to analyze Australia's current economic situation. Have we already entered a recession? What impacts will a recession have on interest rates? And in a recession, will Australian house prices rise or fall? Hi, I'm Alex. Welcome to Aus Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. Where did the recent wave of pessimism come from? It all started with the Black Monday in early August. At that time, global stock markets were in turmoil. The S&P 500 in the US dropped 2% in a single day, marking its worst performance since 2022. Over the course of a month, the S&P fell 8.5%. The Dow Jones dropped 6%, and the tech-heavy Nasdaq plunged 13%, officially entering a correction phase. The Nikkei index was even more dramatic, plummeting 12.4% in freefall, triggering a circuit breaker for the first time since Japan's 1987 stock market crash. And that's not all. In Q2 of 2024, Warren Buffett sold half of its Apple stock. This marked the third consecutive quarter in which Buffett sold Apple shares, leaving Berkshire Hathaway with a record $227 billion in cash reserves, ready to buy the dip. Goldman Sachs raised the probability of US recession to 25%, driven by the sharp surge in unemployment rates. And next, we saw a significant drop in international iron ore prices. Many began to worry that Australia's export commodity might no longer be profitable. Then came Australia's poor GDP figures. Everyone became quite pessimistic. Among them, many started to worry about Australia's real estate market. During this series of events, I also felt a bit pessimistic, just being honest here. But I quickly got my confidence back because both my own and our members' property investment portfolio have risk control mechanisms in place, supported by long-term investment mindset. In other words, we are ready to face potential economic turbulence. So what exactly is going on with the Australian economy? The latest data from the Australian Bureau of Statistics and the Reserve Bank of Australia has just been released. For the 23 to 24 financial year, Australia's GDP grew by only 1%, marking the worst performance since the 1992 recession, apart from the pandemic years. Per capita GDP has been declining for 6 consecutive quarters, falling by 1.5% in the 23 to 24 financial year. The recession in per capita GDP is already a confirmed reality. Productivity, or the value produced per hour of work by Australians, has dropped for 2 quarters. These figures reflect the economic downturn, and on a more tangible level, we can feel the rising cost of living, the unaffordability of housing, persistently high interest rates, and immense pressure on mortgage repayments. Even the governor of the Reserve Bank has advised those who can no longer afford to pay the mortgage to consider selling their homes. Has Australia already entered a technical recession? The same week the RBA released its report, Australia's treasurer jumped in early, stating Australia's high interest rates have crushed the economy, which seemed like a subtle way of shifting the blame to the central bank. But when the RBA report came out, it confirmed that while interest rates are high, the economy has indeed taken a hit. This is the consequence of 13 rate hikes. Some of those hikes were double-sized at 0.5% each time. In total, the rate hikes over the 2-year period are equivalent to 17 increases, a pace almost unprecedented in Australian history. Unexpectedly, though, Australia has so far avoided a technical recession, meaning we haven't experienced 2 consecutive quarters of negative GDP growth. However, the fact that we haven't hit a technical recession is a little more than a statistical loophole. GDP is a crude measure of economic performance. It calculates how much goods and services were produced over the course of a year. When the population is stable, using GDP to measure the economy is reasonable. But Australia has brought a massive number of immigrants over the past 2 years, and each of them contributes wealth, making Australia's overall GDP appear not to have contracted. But if we exclude the impact of immigration and international students, per capita GDP has been falling for 6 consecutive quarters. In 2023 and 24 financial year alone, per per capita GDP fell by 1.5%, indicating that the average living standard of Australians is declining. While Australia may not meet the definition of a technical recession, in reality we've been in a recession for a year and a half, starting not long after the RBA began raising interest rates. So how does the economy affect interest rates? The simplest way to understand interest rates is this. If the economy is doing too well, inflation will rise, and interest rates need to be raised to cool down the economy. So high interest rates usually indicate a healthy economy. If the economy is struggling, inflation will drop, and interest rates need to be lowered to stimulate the economy. Low interest rates typically suggest a weak economy. But right now, Australia's economy is in bad shape, yet interest rates remain high. Given the current economic trend, the logical next step would be a rate cut. There are two conditions that need to be met for the RBA to lower rates. Number one, inflation needs to be in the 2 to 3% range. Let's take a look at the inflation trend. Australia's trimmed mean CPI for the second quarter has dropped to 3.9% year-on-year. In July, inflation fell to 3.8% year-on-year. The trend is the same. Prices are still rising, but the rate of increase is slowing down. Once these figures get closer to 3%, the RBA will have its first reason to lower rates. Why not bring inflation down to 0% so prices stop rising altogether? Well, actually, a little inflation is beneficial for the economy. For example, let's say you lend me $100 with a 5% interest rate. A year later, I need to pay you back $105. But if inflation is 8%, meaning something that costs $100 last year now costs $108, you, as the lender, would only receive $105. While you've collected the $5 in nominal interest, you've effectively lost $3 in purchasing power. In other words, your wealth has shifted to me, the borrower. I've diluted my debt through inflation. This means that a moderate inflation rate is actually good for those of us with mortgages. Imagine if you bought a house in Sydney 40 years ago for $100,000, borrowing $80,000. If you haven't made any payments until now, you'd find it much easier to pay off the debt, perhaps within 2 years. But back then, the same loan might have taken 10 years to repay. This is due to 40 years of inflation. The second condition for the RBA to lower rates is that the unemployment rate needs to exceed 4.5%. Once it crosses this threshold, the RBA will be compelled to lower rates to safeguard Australians' living standards. Currently, Australia's unemployment rate stands at 4.2% and is trending upwards. Some people argue that rate cuts aren't coming anytime soon because the RBA governor has stated that rates will remain high for a considerable period. I did a poll on both the Chinese and English channels about the outlook on interest rates, and the results were quite interesting. Fans in the Chinese-speaking community tend to believe the RBA will cut rates sooner, with many dismissing the governor's statements about keeping rates high for an extended period. Meanwhile, Australian fans on the English-speaking channel are more inclined to trust the governor's words, expecting a delay in rate cuts. If you believe what central bank governors say, you either don't understand history or have a short memory. John Howard once said Australia would never introduce GST. Bob Hawke claimed that by 1990, no Australian child would live in poverty. The current Labour government broke their promise on the third stage tax cuts on the very last day. The previous RBA governor said in the early days of the pandemic that rates would stay low until at least 2024. Things change over time. The RBA governor can't make decisions against the market forces. Everything depends on how the market moves. So we ordinary people should learn to follow the market, not what the governor or the media say. If you want to understand the market's view on Australia's interest rates, the simplest and the direct tool is the ASX RBA Rate Tracker. This is a chart compiled by the Australian Security Exchange based on the market expectations for the RBA's rate decisions. It shows the projected direction and likelihood of rate changes based on the 30-day interbank cash rate. For example, if the chart shows a 10% chance of a rate cut on September 10th, it means that the market believes there is only a 10% chance the RBA will cut rates in its next meeting on September 24th. Currently, the market expects the first 0.25% rate cut to happen around January or February 2025. However, you should note that these charts change quickly, almost daily, especially when major events occur in the economy. And thus, they should be seen as a reference, not a prediction. Now, the key question is, what impact will Australia's recession have on housing prices? Let's take a look at the relationship between Australia's past economic trends and housing prices. The blue line in this chart represents the average housing prices in Australia's 8 major cities over the past 140 years. Since World War II, Australia has experienced multiple recessions, including the 1960, 70, 80, 90, 08, and the 2020 pandemic. Although not all of these met the technical definition of 2 consecutive quarters of negative GDP growth, rising unemployment and declining living standards show Australia was in recession. In the recessions between 1960 and 1990, the average house prices in the 8 major cities experienced short-term drops, followed by recoveries. As we approach the present day, the declines in housing prices became shallower, slower, and shorter in duration. For example, during the pandemic recession in 2020, housing prices fell by only 2.3% and started rising again in October after just over 6 months of decline. Looking at this chart makes the answer even clearer. It shows the fluctuations in Australian housing prices from June 1981 to June 2023. Anything above the horizontal axis indicates rising prices, while anything below indicates falling prices. During the 1991 recession, housing prices barely dipped before entering a 5-year upward trend. In 2005, even as the economy strengthened, housing prices experienced a slight decline, followed by 4 years of growth. There was a slight drop during the 08 to 09 financial crisis, then 2 years of growth. Price dipped slightly again in 2012, followed by 7 years of gains. In 2019, price dropped slightly, and then came the pandemic and the post-pandemic boom. Several patterns emerge from this. Number 1, economic conditions are not the sole determinant of housing prices. While the broader economic environment is one factor, housing prices are the result of many interacting factors. For every negative factor you can find, there's likely a positive one on the other side. The most direct factors influencing housing prices are supply and demand, and both are driven by a range of elements, such as interest rates, immigration, fiscal policy, inflation, labor costs, and productivity. Number 2, we've been in a recession for a year and a half. The technical definition of a recession just makes us think we haven't entered one. People's living standards have fallen, businesses have closed, and unemployment has risen. If that doesn't count as a recession, then what does? Per capita GDP has been declining for 6 consecutive quarters, and more people are struggling to repay loans in this high-interest environment. Yet Australian house prices have risen for 19 months, further proving that economic trends and housing prices are not always linked. Number 3, have you ever wondered why Australia has managed to bounce back so quickly from economic recessions, even when housing prices have slightly dipped, only to quickly stabilize and rise again? During a recession, the government will never just sit by and do nothing. They will always find various ways to combat the crisis, such as printing more money, lowering interest rates, increasing immigration, relaxing loan restrictions through APRA, and introducing policies like using your super to pay a property deposit plan launched on September 15th. If Australia enters a technical recession, the RBA will be the first to step in and start a rate-cutting cycle. Once interest rates drop, borrowing costs go down, repayment pressures ease, and people have more money to buy better homes. Those who were once forced to sell can now hold off, reducing market supply. With more buyers and fewer properties available, housing prices naturally gain upward momentum. Unless Australia faces a comprehensive systematic economic issue or population crisis similar to China's, where no stimulus works, the housing market is unlikely to experience a prolonged downturn. Every year, immigration alone helps sustain housing prices in major cities. If the government really wanted to lower housing prices, they might have to halt immigration for 10 years. That might work. Number 4, in the short term, Australian housing prices may fluctuate, but in the long term, they've always gone up. This is true for the overall market as well as for individual city markets. You can see another pattern in this chart. Each time housing prices pull back, they don't last long, while the subsequent boom period is significantly longer and faster. Looking at the data from the past 40 years, the shortest interval between 2 peaks in the Australian housing market is 2.25 years, and the longest is 6 years, with an average of 4 years. The last peak was in March 2022, so if we follow historical trends, the next peak could occur around March 2026. Over the next 18 months, Australia may experience a technical recession or brief market correction, but with the support of various policies, it's more likely that we see a market upward trend. My view is that while the Australian housing market may experience short-term fluctuations, the long-term outlook is positive. Although the 8 cities follow different property cycles, the overall trend is upward. But if a technical recession does occur, I don't see it as a bad thing. In fact, I think it would be a good thing because a slight easing in house prices would be a perfect time to buy. However, even if recession happens, housing prices may not necessarily soften. As property investors, including myself, we are neither economists nor fortune tellers, so we can't predict the future. What we can do is manage the present, adjust our portfolios, introduce risk mitigation mechanisms, and prepare in advance to ensure that if a crisis comes, we won't be forced to sell, turning paper losses into actual losses. For our paid Vision members, we create tailored property investment plans that not only include a substantial portion of stable, foundational assets, but also a smaller portion of high-risk, high-reward opportunities, depending on each member's risk tolerance. In each unique investment plan, we also implement a cash flow red line mechanism to ensure that holding properties isn't a financial burden. As long as the property itself is solid and you can weather short-term difficulties, it's not a question of whether you will make money, but how much. If you've made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos, and have a good one. Bye-bye.